afternoon. How is everyone? I am an attorney at Mass Mutual. I was in the private practice before coming in-house, being recruited to come in-house. I do have my JD, which means I'm a lawyer. I practice. I wasn't boring enough, so I went to Boston University School of Law and became a master's in tax. That's what the LLM is for. Legal Laws, Master's in Taxation. It's not glamorous. As I told the last group this morning, my mom won't even talk to me, finding out that I'm a boring tax attorney. But with anything in this practice, what do we all know? That you have to deal with compliance on a daily basis, correct? How is compliance? They're great when they're sleeping. I'm not going to lie to you. They want you to know that anything I tell you today, you cannot rely on, you cannot believe in me, and therefore you have to go out and get representation from someone who's competent, which is not me. So therefore, I developed that last set of letters. If you heard me this morning, it was a different set. This is a new set because you've heard me once. Any guesses on my last set of information? What? Completely full of sugar. This is a very polite group, and I am PG. So, yeah, completely full of shit, so don't believe me. What are we going to get into? Before we jump in there. A lot of people ask, Todd, where do you get your information other than the code section and all that fun stuff? I, at the home office, do my own research. And therefore, when I do my research, I put in lovely graphs. Take this first one for a minute. Things that I like to do when I go to Jersey and I teach. The shore is pretty nice. Six Flags is not bad. Atlantic City's okay. But there's one thing that stands out when I like to go to New Jersey. I'm not going to tell you what it is. Honestly, I had this slide in there, and I forgot I was going to Jersey last week, and I pulled it up. Not going to lie to you, not a lot of humor in this one. The next one is, think about yourself this morning. You're at the toaster. What do you do when you're waiting for the toaster to pop up? Me, I go and get butter, sometimes peanut butter. I may or may not clean up a bit, but the rest of the time I'm doing what? The same thing you are doing. You're staring at the thing as if it's going to move. The final one is, and this is history, the story of my life. Girls I liked, girls that liked me. Not a lot of crossover. So just letting you know, these are true facts, people. I don't make this stuff up. What are we going to talk about in the very limited time after speaking? You're not going to invite me back. I understand. We're going to talk about personal planning, business planning. Really, if I have a whole life policy or a regular life insurance policy, who owns it and what are the tax ramifications to it? That's all we're going to talk about. If you have questions, what do? You raise your hand, right? No, I'm not answering any question. I'm only kidding. You can ask any question, stop me at any time. So, I'm not a big code section guy. I'm just a tax attorney. But with life insurance, if I own it at its inception, or if I don't own it, is it in the estate? For estate tax purposes, if I own a life insurance policy, whole life, UL, or term, it's in my estate for estate tax purposes. Here's an example. Julie is the insured. The daughter is the owner and beneficiary of a policy on her life. Julie, the mom, just call it, is paying for it. Is the death benefit in her estate? No, she doesn't own the policy. Just because she's giving the money to the daughter to pay for it doesn't give her what the IRS calls incidence of ownership. Therefore, out of the estate. What if I have it owned inside her trust? Is it out of the estate? Thoughts? Julie sets up a trust. She's the premium payer of the policy. Is it in or out of the estate? In. So why would you say that? That's what I'm looking for. In essence, is it revocable or irrevocable? That is the nuance that we run into with clients. Clients will say, I have a trust, therefore I have done estate planning. Stop, ask the client, can I see the trust? Is it revocable or irrevocable? That will give you the difference. Because 2042, and I know I shouldn't give you codes, but I'm going to, if I have incidence of ownership in any way, shape, or form, then it's in my estate. They pull it in my estate and count it. Think about it. I have a client who has $4 million, and they have a $10 million policy. They own the policy. They die. You take the $10 million plus the 4, guess what they now have? That $14 million. What's your exemption currently? $5,250,000. So I've gone over that exemption. Guess what I have? I have an estate tax problem. And it's taxed at what? 40%. Now, what's next year's exemption? Oh, I heard we don't know. What?
5,340.
5,340. Where did you learn that? You learned it this morning. Someone was listening. Now, would that 5,340 hold true forever? Why not? It's on a graduated scale. So really what that means is next year it's going to go up again. 5,450, whatever it is, it's going to go by cost of living. Here's the real issue. In January of this year, they passed ATRA, the American Tax Relief Act, which gave us the $5,250,000 to then get indexed up going into the future. And they called it permanent. Right. With the caveat and the asterisk and everything else that said, until changed. 2 months later, what did the president do in his budget? He said in his budget, in order to raise revenue, he forecasted that we go back to the old rules of 2009. What are the old rules of 2009? 3.5. What's your gifting capacity? 1 million. What's your GST, generation skipping tax? 3.5. It's always tied to the estate tax. So they passed it saying it's permanent going forward unless an exception applies. 2 months later, the budget said we want to go back to 2009. 3.5 per person, $1 million exemption for gifting purposes. And the tax rate would be 45%. So now think about it. 2009, you had a $3.5 million estate tax exemption. Your gifting was $1 million. 2010, what did you have? 0. What did I teach you this morning? Who do you remember in 2010? Steinbrenner. What happened to Steinbrenner? How did he die? They can't prove this, but I'm going to tell you. In 2009, the guy was dead. This man was so sick, he was gone. However, the kids kept him on life support. 2010, they unplugged it. I can't prove that. I'm kidding. But in 2010, he died because there was no estate tax. 2011, what did they do? They changed it to $5 million. 2012, what did they do? $5,120,000. Now think of your clients. 2013, you sit with them, you tell them it's going back to $1 million at 55%. And then it goes to $5,250,000, which the next year will be $5,340,000. What are your clients looking at you as? That you're nuts. You don't know what you're talking about. But that's what's going on in D.C. It's going up and down. And I heard people about the PAC. It's a very important group to get involved in because one of your congressmen, who's from my hometown, Western Mass guy, speak with a very bad lisp and everything else. I'm a Boston kid. Congressman Richie Neal. What did Congressman Richie Neal do prior to becoming a congressman? Sold life insurance. Then he became the mayor of Springfield and moved on to be a congressman. He understands how it works. It's those type of people you have to educate because a lot of people don't understand how these rules work and how life insurance works in estate planning. So those are your estate taxes. If I have incidents of ownership, I own it, it's in my estate, I'm over those exemption benchmarks, whatever they may be in the future, I have an estate tax. 2035 says if I transfer the policy, I own it. I transfer it to you, my daughter, or I transfer it to my irrevocable trust. Then I have to wait 3 years and 1 day to get it out of my estate. If I die within that time frame, they still pull it back in. So although I made a gift to get it out for calculation purposes, that code section says we'll draw it right back in if you die too soon. Now, here's my fun one. I get this from clients all the time. Well, I'm cheap. I'm not going to pay for an attorney. Therefore, I'm going to come up with tricks. And what I'm going to say is I'm going to have joint ownership. Dad doesn't want to pay the legal fees, so he names child A and B as the owners of the policy. Therefore, Dad pays the premiums. It's a gift. So the pros are it's out of the estate. It's not, Dad doesn't own it, so he doesn't have incidents of ownership. And there's no cost to setting up a trust. Here are the cons. Multiple owners requires multiple signatures. One child may live here, one child may live in Massachusetts. How are they going to sign off on it? Here's a true story. I get a phone call. Client says, I don't want this ILET anymore. I'm tired of my trustee charging me fees to send out crummy notices. And we'll get into crummy in a minute. I say, oh, okay, what do you want to do? Well, I'm going to take the policy from my trust and give it to my kids and joint ownership. Well, you really can't do that. Trust prohibits it, but go on. Why? Well, I don't want to pay him anymore. I'm tired of paying him. I said, well, here's some cons, you know. Your kids live away from each other, therefore they can't sign off on it. Not a problem. I'll get around it. I'll make sure I mail it, FedEx it. They'll send it back. I said, oh, okay. Well, here's the other real problem, gifting. If I have my 2 sons over here own a policy on me, what do we know for annual gifting capacity? What's our annual gifting exemption? $14,000. That's me giving my kid $14,000. He walks away with it. If I give him over $14,000, I have to file what? A 709 gift tax return to get my lifetime credit. They're joint owners of the policy. If I give them the money, or I give it to Mass Mutual, have I made a present interest gift? Most times, I pay Mass Mutual or whatever insurance carrier. It doesn't matter to me. I pay the insurance company directly. They own the policy on me. Under the code section, that's not a completed gift because they have joint ownership, and therefore, I haven't given it to a specific person for a present interest gift. Therefore, what I have to do is I have to cut a check to son 1 and son 2, and hopefully they pay the insurance carrier in order to qualify it for the annual gifting capacity. If I don't do that, I automatically have to use up my lifetime credit. Gentleman says, not a problem, I trust my kids. I said, well, they could take the money and run. No, they won't. I said, well, they could have creditor problems. If I own a policy, creditors could come after the policy. It's an asset for them, unless the state offers up an exemption. My kids are fiscally sound, not a problem. What does that one say? Divorce. Remember, any asset owned in your hands is subject to a divorce. If it's owned inside a trust, and I have spendthrift provisions and all the other bells and whistles, does a divorce, in essence, shield me from that liability? The answer is yes. So in this case, when I told them, look, if you send the policies out to your 2 kids, technically you can't, but if you did, what happens with divorce? Dead silence on the phone. I said, well, did I lose you? Well, no, he didn't like the daughter-in-law. And there was the hopes that his son would divorce. True facts, of which I said, now how do you like your trustee? I still don't like the trustee. I said, here, do you have trust provisions to remove the trustee and put in a friendlier trustee? Aunt, uncle, friend, what have you. Yeah, get rid of the trustee, put in someone who's not going to charge you. Simple fix. So joint ownership, good, it's out of the estate, but now you have a list of problems that can come up. Creditor problems, divorce problems, and your gifting problems. So here, for a single person, we have our lovely lady at 32. She owns a policy on her life. Her mother is Mary. Premium payments are directly to Mass Mutual. That's fine. We'll just call it an insurance carrier to keep it because we know we have multiple insurance companies. She names her sister, Rachel, and brother as beneficiaries. Do we have a problem? Good news is it's out of mom's estate for estate tax purposes. Mom is Mary. We're owning on mom's life. Mom's gifting to us or to the carrier, not a problem. But we're naming Rachel and Bill as beneficiaries. Is there a problem there? No one's ever heard of the Goodman Triangle? Goodman Triangle, this is a weird case. It gives an adverse gift tax consequence to the owner. So once again, daughter owns on mom, names the other 2 siblings as beneficiary. By doing that, this case, the Goodman case, said it's as if the owner wanted to make a gift to the beneficiaries, the other 2 siblings. And by not changing it prior to the death of the insured, you must have wanted to make a gift, and therefore, that death benefit going to those kids is a gift. Now think about it. Maybe it's a $500,000 policy. I have a lifetime exemption. Probably not a big deal. They go back to the 2009 rules, where your gifting exemption is not $5,250,000, it's $1 million. Also, it's not a $500,000 policy, it's a $5 million policy. Does our owner, daughter, have a gift tax problem at 45%? That's what the Goodman rule did. If you have 3 parties to a contract, owner, insured, and beneficiaries are different in any way, shape, or form, you better fix it. The quick fix here is daughter owns and the other 2 siblings are beneficiaries. Well, make all the siblings owner and Benny on mom's life. Now you only have what? 2 parties to the contract. If you don't do these, I call them stupid little fixes, the ramifications are serious. 40%, 45% tax on a death benefit. When we all know under 101A, what is life insurance? Death benefit is tax-free. By messing up with the rules, you put it right into ordinary income taxes or gift taxes. Now, on to our trusts. What I said was, if I own a policy inside a trust, it's outside of my estate. And then we heard over here, well, stop. What type of trust? Your revocable trust, and never forget this, has no income, gift, or estate tax purposes. Then why would I set this trust up? It's probate. So if I have assets at my death and I die, my will says everything goes to my spouse or whoever I name. That has to go through the probate court system to say how my stuff gets allocated out. Life insurance avoids the probate because it has a beneficiary designation. Same with annuities, same with your qualified plans, IRAs and everything else. A lot of times our clients name their estate as beneficiary, so then the will kick out the money. Well, by doing that, you put it right back into the system, which then court costs, attorney's fees. If there's creditor issues, they're coming after this stuff. It's fair game again. So people say, well, I'm going to set up a revocable trust to do estate planning and probate. It avoids probate. I don't have to go through the system and avoid the cost. No, stop. With a revocable trust, it's you. In essence, I transfer title of assets into the trust. Upon my passing, everything passes according to the terms of the trust. But prior to death, if I don't like what's in there, I can take it back. So I put my house in there. 2 days later, I take my house out. 2 days later, I keep putting it back in there. Does nothing for me for estate, gift, or income taxes because I still control it. Your irrevocable is you've given it up forever. I gave up control in its entirety. I put it in. It's a gift at the time. What was the fair market value of the policy when I transferred it in? Does anyone have a guess? I get that all the time. If I transfer a policy into my trust, what's its fair market value? For what? For a whole life, term, UL? I heard up front, interpolated terminal reserve, and you're absolutely right. For whole life. Remember, 2005-25. It's sad that I know all these code sections. I'm sorry. But that revenue ruling said, from now on, for fair market value of a policy, they call it 712 value. Well, the interpolated terminal reserve for a whole life contract. A UL or a variable product is statutory reserve or PERC, P-E-R-C. What really happened is the IRS forced you into recognizing what the fair market value of a policy was. How many of us heard of springing cash value? Yep. This is why it came about. I would have a qualified plan owning life insurance. In the first 3-4 years, I'd suppress the value and just hold it. And then I'd turn to my client and say, set up your ILET and buy that policy out. And you'd say, okay, buy it out for its cash value. Well, okay, the cash value is this small. So I buy it out, it goes inside my trust, it's outside of my estate. Qualified plans made whole, that was the value at the time, cash value. Lo and behold, year 4, year 5, what happens to the value? Explodes. Who owns the policy? His trust. Of which IRS said, that's an awesome trick. Here's a better one, 2005-25. Interpolated terminal reserve, PERC or statutory reserve. You're forced into it. And if you don't, we'll see you for interest and penalties. That's what happens. So I put my ILET together. I have my policy in there. Remember, if I own the policy, I transfer it to my trust, 3-year rule. If the policy is owned inside the trust from day one, is it in my estate for estate tax purposes? No. Now, we talked quickly about crummy, but here really what it is. Remember, I can go around this room and give everyone in this room $14,000 or less. That's your annual gifting capacity. Well, I set up a trust of which I have my 2 children here as beneficiaries. I make a gift to the trust. Did I really gift them anything? Because the trustee then takes the money and pays the insurance carrier. Did I give them a present interest? Now back up. To have a good qualified gift, you have to have a present interest, which really means here's $14,000. They walk, I never see them again. That's present interest. They have it, they're gone. Change the facts. Here's $14,000. You can keep it as long as you run around this building 5 times and finish your dessert. I will know at the end of this meeting if they've completed that task. If they don't, guess what I get? I get to pull my money back. Do they have a present interest? No, they have a string attached to it. Back to crummy. I put money inside a trust. Trustee takes it, gives it to the insurance carrier. Did the kids really have it? That's what the IRS jumped up and down on this case. They said they never had control of that money, and therefore they never present interest in it. Enter a very, very smart attorney, of which he said, stop. I agree with that concept. However, I gave a notice. I sent my 2 lovely kids this letter that said you have a right to take the $14,000. You have 30 days in order to exercise that. If you don't, it's going to lapse, and therefore my trustee has to do something with the money, i.e., pay the insurance. So, do you guys want the money I just gave you? No. So it lapses, and they pay the premiums. IRS jumped up and said, stop, that's not fair. Because he told them, nod, nod, wink, wink, you touch this money. I will never make another premium payment again. I will never give another gift to you. Of which the client said, you can't prove that. I've never said that. IRS said, well, since you can't prove, or the court said, since you can't prove that, they had a limited right. And since they let that right go, they had an interest in the money, and they just said, we're not going to touch it. That short time frame, 30 days, is enough to give you the present interest. IRS has hated this rule from the day they lost the case, and they still try and pass bills in Congress to get rid of crummy. But really what it does is it gives you the right to give your kids the present interest and not count it towards your lifetime credit. Think about it. If I didn't have this case, when I make a donation or a gift to the trust, what can I do? My wife and I can gift split $28,000, $28,000. First 56 is a freebie. The premium is $60,000. $4,000 comes off my lifetime credit. Not bad. Well, I don't have this case. The full $60,000 comes off my lifetime credit. If we go back to $1 million, change the facts a little more. The premium's $150,000. I don't have the right to present interest gifts. How fast am I going to go through that $1 million lifetime credit? What?
6, 7 years.
Yeah, quickly. So therefore, what do I have at the end? I have a gift tax problem. So that's really what the problem is. That's why crummy works so well, because it gives me my freebies up front to then lessen my impact. Now, I always get a question, well, what is a typical ILIT? Well, spouse can be, in essence, I'm the grantor. My spouse can be a beneficiary. I make gifts to the trust. The trustee sets up a checking account for the trust. Takes the money, holds it, sends out the notices, waits 30 days, then cuts the check to the insurance carrier. That is a typical way of doing it. So my spouse can be a beneficiary and the trustee. My kids can be a beneficiary and a trustee. But what I do in order to avoid them having an estate tax is I limit their rights to the principal. I can give them rights to an income stream over a period of time, but then limit having my wife being able to attack the principal for health, education, maintenance, and support. Your HEMS language, they call it. Those are limited powers of appointment. And if I do that, upon my passing, it's not my estate. Upon her passing, it's not in her estate as well. So that's the true benefit to an ILET if we do it correctly. Here's what certain attorneys try and do. They try and broaden that power. And they say, I can do it for pretty much anything, in essence, forcing them into a general power of appointment. And if you do that, upon her passing, the whole death benefit comes into her estate for estate tax purposes. The code section 2041 is very clear. Limit her powers to the HEMS language. Think about it. Health, education, maintenance, and support. What doesn't that cover? Pretty much covers everything, so long as you have a friendly trustee to pay out to the spouse. Now, normally what I hear is, I sit with my client and I say, you need a whole life policy. You're 35, 40, 45 years old. Get a whole life policy for what? Supplemental retirement. As the cash value grows, tax-free, tax-deferred, you can pull from it tax-free up to basis, then put a loan on the policy. So it's a supplemental retirement piece. Good tax benefit. You die, death benefit goes to your family, tax-free. Okay, makes sense. I like it. So I put it in your hands. You're the owner. You sit with the attorney. He says, don't own that policy because you're worth $6 million. And if you get this policy, you're going to have an estate tax problem potentially. You say, I want control, access to supplemental retirement, but I don't want the estate tax. Can I have both? Any thoughts on that? Can I set up my ILET and have full reign over it to get what he wants, that supplemental retirement piece? You tell me. It's yes. And that's the whole thing. My ILETs, people hear ILETs and they get scared of them. I lose control. Stop. The ILET, if drafted correctly, I like to call it a checking account with some little strings attached to it. If I'm happily married, I am right now. Don't get me going. All right. I name the spouse as a beneficiary. I give her access for health, education, maintenance, and support. If she takes a distribution for that and uses it for husband and spouse, what's gifts between husband and spouse? Unlimited. There is no limitation. It's not subject to the $14,000 or your lifetime credit. It's unlimited. I could give my spouse $1 billion. I don't have to file any tax returns. So with the trust, we make her a beneficiary. She pulls from it. She uses it for her and I. That's my indirect access to get his supplemental retirement / estate planning. What is the very next question by the client? See, it always comes up. Divorce. What happens if we divorce? Can I obviously have access to it now? Yes, you still can. Obviously not through the spouse. Whether she dies or divorces you, you still have to put inside the trust loan provisions. If my trustee can give loans or take loans from me, then I can turn to my trustee and say, give me a loan attached to historically high interest rates that we currently see. Seriously, what's your interest rate today? 2.0. So I take a loan from my policy, from my trust. The loan amount is in my estate for estate tax purpose, but the death benefit stays out. So that's how you do it, whether it's through the spouse or through loan provisions. Still gets him what he wants. Supplemental retirement planning, estate planning on this side. You get the best of both worlds. If he dies, what's in his estate? The loan. That's it, not the death benefit. Here's a question that comes up a lot, and we'll go through a couple of questions, and I know you want me on a time frame here, so keep. Okay. So can I backdate a policy in a trust to save age before the date of the trust was established? So let's back it up. I'm applying for a life insurance policy. I go to my great attorney, and I say, I need an ILET. He says, I'll get back to you in 2 months. What is he doing? Dragging his feet, like attorneys do. It's not our problem. So we're delayed on getting a trust in place. Finally, prior to issue, I say, the trust will be the owner of this policy, and we'll have the trust be the owner and beneficiary. Was it in my estate for estate tax purposes? No, because the trust owned it from day one. change the facts a little more. They issue me the policy for a day. I change ownership to my trust when he finally puts it into his existence a day later. Is that in my estate? Yes, and the 3-year rule applies. So the issue time was, if I issue it to the trust, we're okay. Issue to me, even for an hour, it's in my estate. This question is saying, can I backdate a policy to save age, which helps on the premiums and everything else? The answer is yes. It has nothing to do with the ownership and the rights. It has only to do with if I'm backdating in order to get a better insurable interest or premium payments. It has nothing to do with ownership. So can I backdate to save age? The answer is yes. It does not cost me for estate planning purposes. Does everyone see that? I know a couple frowns going on. Think about it. I usually have a flip chart to make it work. But the policy is issued December 31st. My trust was in existence December 30th. Since my trust is up and running, the policy is issued the day later, you're okay. All I'm doing is backdating the policy for age purposes, not to backdate past the trust. Slight difference. Premium payments. The insurance, is the insurance included in the insured's estate if I pay the premium directly to the insurance carrier instead of making gifts to the trust? No, because there's no instance of ownership. We don't care. If I make direct premium payments to the insurance carrier and not to my trust, it's not inclusion for estate tax purposes. Here's the catch. What about your annual gifting capacity? Remember your crummy notices. If I make a premium payment directly to the insurance carrier, do I qualify for my annual gifting capacity? You hear a no? I can do that. Anybody? Anybody? 2, 4, 6? No? Okay, we're not doing an auction. The answer is we're not sure. It's unclear. Because you have to change the facts a little bit. If it's my first premium payment and I make it directly to the carrier, is there any cash inside that trust? No. So if the kid exercised his right to get the cash, I can't pay it. So therefore, how can I give something when I don't have it? Hence the argument back to the IRS, which is you don't have the cash to pay out the present interest. So right there, you're in trouble. However, I have a whole life policy. I have stocks. I have bonds. I have something else in the trust. I pay the insurance carrier directly. Did I give a present interest to the kids? The answer is yes, because I could have sold some of the other assets or pulled from the whole life policy's cash value to pay out the promise. And so long as I had that right, I have a present interest. So it becomes not so clear, and there's private letter rulings, but really, what other assets do you have in the trust to pay out the promise? If you have it, you're okay. If you have nothing, harder argument to sell.
Question for you. So with term insurance then, you wouldn't have to do the crummies and all the gifting?
You have to. The question is, if you have a term policy inside there, you don't have to do the crummy. Absolutely do. If you ever want to qualify for the $14,000 annual gifting or $28,000 because I'm gift splitting with the spouse, you have to send out the crummy, whether it's whole life, UL, or term. The only problem is if you only have a term policy in your ILET and you make the premium payment directly to the insurance carrier, can you really pull anything from the policy to pay out the promise in theory? The answer is no. So you might lose the argument to an annual gifting. That's all. Now, loans. Can I do loans to a trust or take loans from it? Yes, you can. They've, in essence, opined on that and said, not a problem. Must an ILET apply for a taxpayer identification number? Must I file a gift tax return for all the gifts? Well, for the first one, no. We get this a lot. Can my trust use my Social Security number? Yeah. Under the grantor trust rules, I use my Social Security number. I'm okay. Because for income tax purposes, everything falls to me. Why then do a lot of attorneys get an EIN number from day one? What happens when I die? Do I have a Social Security number anymore? No, I'm dead. So I have to apply for one anyways. So might as well apply for it now and get it done. But for income tax purposes, even though I have an EIN number or a TIN number, they sometimes refer to it as, it's still for income purposes me. Why in God's name would I want my ILET under the grantor trust rules to put the income tax to me? which, think about it, I have S corporation stock. I gift that stock to my islet. As the money's coming into an S corp, what does it mean for me as a taxpayer? I pay taxes. It's a flow through. Comes to me in my pocket. I pay taxes on my 1040. It's now inside, call it 49% of the shares are inside my islet. As the money comes in, 51% comes to me, 49% goes to my trust, but in both cases, I'm electing to pay the taxes on the full 100. Am I nuts? Why would I do that?
You get to make an additional gift to the beneficiaries by doing that.
Additional gifts to beneficiaries. Yes, can you elaborate on it just a little more?
So if I've got a $14,000 annual exclusion, I can make that $14,000, and if the taxable amount, let's say, is $6,000, I've actually improved my beneficiary's position by $20,000.
Correct. Now, I'll elaborate. You're absolutely correct. I'll elaborate on it a little more. What the IRS has said, by me paying the income taxes that are due, in essence, it flows through to me, they won't deem it as a gift. That's huge. Remember, every time I make a gift to the trust, it's $14,000. If I go over it, I'm eating away at my lifetime credit. It's my S corporation. $1 million comes in. I have to pay taxes on it. Call it $300,000, of which just call it $150 is the taxes that are due to the trust. That would be $150,000 of a gift that I made to the trust, of which I'd have to eat away at my lifetime credit. If we go back to the old 2009 rules, which is on the table, how fast am I going through that credit? Extremely fast, and then now I'll have a gift tax problem. However, with the grantor trust rules, since I'm paying the income taxes, that $150 is not deemed a gift. It doesn't have to count against my $14,000, and it definitely doesn't count towards my lifetime credit. That is a huge benefit, and that's why I want to pay the taxes, because one, it's not a gift, and two, what am I doing? I'm depleting this side of the ledger, which is my estate tax issue, and increasing the money going inside the trust, which is really for my kids. So I'm shifting the balance. For gift tax purposes, your 709, you only have to file it if you're over the $14,000. Let me just stay with the trust, and then I'll be done, because I have 3 minutes. If I have an islet, and I have my spouse as a beneficiary, can I still use her to make my gifting? Remember, my wife and I can elect to gift split in any given year and give $28,000 per person. And if we go over that, we're eating away at both our lifetime credits, currently $5,250,000. So my wife and I give $28,000, $28,000. She's also beneficiary of the trust. Can I do that? This just doesn't seem right. Doesn't feel right. Isn't there some types of incidence of control there under 2042, 2036, 2038? She's a beneficiary. We're gift splitting to a trust. Heck, she's also the trustee. Any thoughts? The answer is, so long as I am the one making the gift. It's coming from Todd McGee's checking account. If it's coming from Todd and Mrs. McGee's joint account, then you have the problem. So for gifting purposes, always remember you have an income tax, a gift tax, an estate tax, a GST tax. They're all separate issues. Here, for gifting purposes, and only for gifting purposes, I can elect to gift split my spouse to my trust and qualify it for the $28,000 per person. Even though she's a beneficiary, so long as the money came from me, income tax purposes and everything else, I can gift to that trust so long as she's a beneficiary. If we do it jointly, then she has instance of control. So separate checking account, I pay it in, I'm just using her for her exemption. That's it. So long as she's a beneficiary, which then goes back to our case where you want access for supplemental retirement, we can do it. She's a beneficiary. Probably don't want to make her a trustee because that's a little sketchy on the language, but she's a beneficiary. We distribute out to her for health, education, maintenance, support. That's your indirect access. And for gift tax purposes, we're using up our $28,000 per person to avoid eating up our lifetime credit. Gets a little tricky with the rules and how you put the language together, but unfortunately, I took a career path that allowed me to just read code section to find these nuances to the rule. That's what we do on a daily basis. Try and make sure you avoid the issues that come up. If you were in the session this morning, it was 2 hours of buy-sell. I appreciate you for being there, but that's 2 hours of hell. Anyways, any questions? Because I guess we have a minute. Yeah.
On your first slide, you're talking about children as owners, right?
Yep.
What if the children dies before the parents? Then it will become taxable.
Well, it won't become taxable. In essence, question is, I have joint owners. Brothers A and B own on me. I'm dad. What they own is in the child's estate for estate tax purposes, not mine. Presumably, when we have the child owning a policy on me, they're not in estate tax realm. It's really dad. That's why we want it in their hands. But your question is very valid. Child A dies. Well, they don't have an estate tax, presumably. Maybe they do. We have to count the value. But what happens to the policy? Unless you have tenants in common or joint tenancy, in essence, I die, it'll pass to the brother B. Maybe I didn't want that. Maybe I want it to pass to my wife and my kids so they have the benefit. Then you have to do tenants in common. So depending on how you set up the tenancy, spells out how the policy moves around. Because if you don't set it up right, it could pass everything to the brother, of which spouse of child A is left out, which is what we don't want. Yeah.
With the exemption being 5.25 million per individual, so for a family over 10, how many ILETs have you seen in the last year?
I mean, I've seen a ton of ILETs. We see more ILETs now with the exemption the way it is, simply because there's the issue it's going to go back. And if you think about it, remember, in 2009, you had $3.5 million, $1 million for gifting, and then $3.5 million for your GST. So if I put $3.5 million into my multi-generational dynasty trust planning, so I put in my $3.5 million to take care of future generations, I went over that $1 million gifting capacity by 2.5. I automatically triggered a gift tax at 45%. Since they're all now tied together at $5,250,000, that would be your estate, gift, and GST, I can put $5,250,000 in theory into a trust and never encounter a gift tax problem, and then pay future generations going forward. That's what a lot of people are doing right now. They're taking advantage of the exemptions being so high. They're dumping money into the trust, whether they get an annuity to pay a 10-pay product going forward, whatever. They're doing multi-generational planning. I'm also doing ILETs not for estate tax purposes. Why do I set up an ILET? Creditor protection. And what's the best part? See that little bony hand come out of the grave? Management from the grave. Who here loves Christmas music? Oh, come on. I don't know, holiday music. I'll be politically correct. Holiday music. Ben Crosby, really good. Love him, right? His kids hate him. Why do they hate him? Because his trust spelled out saying, you as the son and me as a son do not receive a penny until age 65. That's how you can put in provisions into a trust to see how you want it paid out over time.
So I guess with Nevada having 365 years,
Yeah.
once again, asset protection, the same purpose with the state tax at 5.25, is it really, it's hard enough trying to sell clients on probate agreements trust, let alone an ILET.
The ILET is, it avoids probate. It manages creditor protection, rule against perpetuities. I think you're getting at that kind of stuff is gone. But really, it's mostly I'm trying to manage stuff for the benefit of the children. I might also put into an ILET special needs language in case one of my kids has special needs, of which any money that passes to that child specifically will give them special needs protection so they don't get kicked off the state assistance. And, well, you can do it revocable too. But that's why we set up trust, simply because we want to make sure we protect our kids from themselves. Yeah, I put in a $2 million policy. My kids are 18, 20. I don't plan on dying anytime soon until they're 50, 60, and they're married. Well, unfortunately, I died. They're 18. Do I want to give $2 million death benefit to an 18-year-old? Not a chance. Therefore, I do the trust to make sure I'm protecting them from themselves. That's why trusts are so beneficial. It's not just estate planning.
I think another hidden advantage is if you use the ILIT and you have 3 kids, at death of the grantor, you can get everything appraised, you know the value, split it by the language of the trust into 3 separate trusts, and you're done. You do it individually, and typically you'll see give them 1/3 at 30, 1/3 at 35, and the last third. Each time you do that, you have to get it all appraised and valued and move it around to make sure everybody's getting an equal portion.
Yeah, and the question, the answer is absolutely right. If I have a trust, I can break it down into 3 separate trusts, or 4, depending on the number of kids. Upon my passing, the trustee will set up separate individual trusts for each and every beneficiary, and then that way they can manage it going forward. Or I can do the other provision, which is the money comes in. At age 21, you get a third. At age 30, you get another third. Finally, at age 40, the rest of the trust corpus goes out to the kid. Each and every time you do that, you're getting it appraised to make sure everyone gets their fair allocation. You can do it any way. Once again, management. I'm not here. However, I'm going to set up a vehicle to make sure that trustee takes care of you 3 kids so that you don't go blow it, especially with a spendthrift provision. I unfortunately married the love of my life, who is now not the love of my life. If I don't have a spendthrift provision in there, the cash goes in your hands, it's fair game in a divorce. Spendthrift says that trustee is in full control of the money for your benefit. He can turn on the water or shut it off to give you money. If he feels you're in a bad situation, he turns off the faucet, you get nothing for a while, i.e., until the divorce is over. Then we'll turn the faucet back on. And we're timed out. Thank you.
Scott, thank you.